The AI sell-off is no longer about hype, it is about who can afford the boom. AI stocks are falling because the boom has become too expensive to finance. The market is not rejecting AI. The easiest interpretation of falling semiconductor shares is that enthusiasm for artificial intelligence is collapsing. The available evidence does not support such a simple conclusion. Alphabet reported that Google Cloud revenue rose by 82% in the second quarter of 2026, reaching $24.8 billion. Its cloud backlog increased to $514 billion, driven partly by demand for enterprise AI products and infrastructure. The company's problem was not weak demand. It was the extraordinary cost of satisfying it. Alphabet spent $44.9 billion on capital expenditure during the quarter, with the vast majority directed towards servers, data centers, and networking infrastructure for artificial intelligence. That spending pushed quarterly free cash flow to negative $5.9 billion, despite strong revenue growth across the wider business. The contradiction is now visible across the sector. AI demand can be real. AI revenue can be growing. The investment can still become too expensive for shareholders. That is the difference between questioning the technology and questioning the economics. The boom requires historic amounts of capital. Artificial intelligence is not primarily a software story anymore. It is a construction, energy, chip, networking, and financing story. Frontier AI systems require vast clusters of advanced processors. Those processors require specialist memory, high-speed optical connections, cooling equipment, and enormous supplies of electricity. The buildings housing them take years to plan and construct. The companies competing at the highest level cannot simply buy a few more servers. They must build industrial systems at national scale. Bank of America analysts estimated that worldwide cloud and AI infrastructure expenditure could approach $1.5 trillion by 2027, representing a year-on-year increase of roughly 40 to 50%. The major cloud companies are already spending at extraordinary levels. Alphabet spent $35.7 billion during the first quarter of 2026 and another $44.9 billion during the second. Around 60% of its technical infrastructure investment went into servers, with the remaining 40% directed towards data centers and networking equipment. Those figures matter because even Alphabet possesses limits. Its advertising business produces enormous cash flows. Google Cloud is growing rapidly. It holds substantial cash reserves. Yet the speed of AI infrastructure expansion still pushed quarterly free cash flow below zero. Smaller companies face a far harsher reality. They do not possess global advertising businesses capable of subsidizing years of construction. They must borrow money, raise equity, sign long-term leasing arrangements, or depend on better capitalized partners. The AI race is therefore becoming a test of balance sheets. NVIDIA is being pulled beyond selling chips. NVIDIA became the defining corporate winner of the AI boom by supplying the processors required to train and operate advanced models. Its traditional position was unusually attractive. Cloud companies, governments, and model developers absorbed the construction risk. NVIDIA sold the scarce hardware. That boundary is beginning to blur. Reuters Breakingviews reported that NVIDIA had discussed providing a financial guarantee supporting a proposed 10-gigawatt Ohio data center development involving SoftBank's SB Energy, with OpenAI potentially becoming the main tenant. The potential structure would not require NVIDIA to build the project directly. It could instead involve backing construction or lease-related debt and helping finance hundreds of billions of dollars in processors. The strategic logic is understandable. If customers cannot finance the infrastructure needed to purchase NVIDIA's chips, NVIDIA can use its own financial strength to help create that demand. But that introduces a different kind of risk. A chip supplier can lose sales if customer demand weakens. A chip supplier acting as financier or guarantor can also become exposed to the customer's credit quality, the utilization of the data center, and the long-term value of the underlying equipment. NVIDIA's reported 4% share price fall after the financing discussions became public showed that investors recognize the danger. The company may remain dominant, but dominance is becoming more expensive to defend. Investors are punishing spending without clear returns. For much of the AI rally, capital expenditure itself was treated as evidence of strength. A company announcing more data centers, processors, or model investment appeared ambitious. Investors feared that any business spending less would fall behind technologically. The calculation has changed. Companies must now explain not only how much they are investing, but when that investment will produce durable profit. Alphabet recently increased its projected 2026 AI spending, contributing to a sharp share price decline despite strong cloud growth. Meta received a more positive response after discussing ways of monetizing excess computing capacity. The market is drawing a distinction between three categories: companies producing immediate AI revenue, companies building infrastructure that may generate future revenue, companies financing the wider ecosystem because customers cannot fund it alone. The first category can still command excitement. The second requires patience. The third introduces credit and solvency risk that many technology investors never expected to analyze. This explains why strong AI demand is no longer enough to guarantee a rising share price. The spending must produce returns faster than depreciation, energy costs, and financing charges consume them. Interest rates changed the entire equation. Artificial intelligence investment expanded initially in an environment where investors expected interest rates to fall. That expectation allowed markets to value distant future profits generously. It also made debt-funded infrastructure appear more manageable. Persistent inflation has disrupted that assumption. Markets entered the final week of July, preparing for a Federal Reserve decision, while assigning a meaningful probability to another interest rate increase. Investors were also waiting for earnings from Microsoft, Meta, Amazon, and Apple to determine whether the largest technology companies could justify their capital commitments. Higher rates affect AI companies in several ways. Borrowing becomes more expensive. The present value of future earnings falls. Long-term leases become harder to justify. Infrastructure investors demand higher yields. Companies must generate more revenue from the same physical assets simply to preserve their expected return. This pressure is particularly important because AI equipment depreciates rapidly. A traditional building can operate for decades. A processor bought at enormous expense may lose commercial value within a few years as faster and more efficient hardware becomes available. Companies financing AI infrastructure therefore face two clocks. The debt may last for years. The technology can become obsolete much sooner. China has added a new source of pressure. The Asian sell-off was intensified by competition from Chinese semiconductor companies. Chinese memory chip manufacturer CXMT reportedly surged by more than 400% during its Shanghai market debut after raising at least $8.6 billion. Its arrival increased investor anxiety that Chinese producers could expand global supply and challenge the pricing power of established Korean and Western chipmakers. That threat changes the economics of the boom. The original investment case assumed that demand for advanced AI processors and memory would remain stronger than supply, allowing manufacturers to maintain high prices and exceptional margins. Additional Chinese capacity could weaken that scarcity. If chip prices fall, AI infrastructure becomes cheaper for buyers. But the companies that invested billions in manufacturing capacity may earn less on every unit sold. This creates another contradiction. Cheaper hardware can accelerate AI adoption while damaging the share prices of the companies that made the expansion possible. The technology may win even when individual investors lose. The strongest companies still have an advantage. The sell-off does not affect every AI participant equally. The businesses best positioned to survive possess several advantages: large existing cash flows, profitable cloud or advertising operations, control over data center infrastructure, access to inexpensive borrowing, proprietary processors or software, and enough customers to keep expensive equipment heavily utilized. Alphabet demonstrates both the opportunity and the strain. Its cloud revenue and backlog show that commercial demand exists. Its cash generation and wider advertising business give it the capacity to invest at a level that smaller rivals cannot match. The same spending that worries investors may ultimately widen its competitive advantage. A weaker company cannot easily commit tens of billions of dollars every quarter. It may instead rent computing power from Alphabet, Microsoft, or Amazon, reinforcing the dominance of the companies already building the infrastructure. The AI boom could therefore survive while becoming less competitive. The winners may not be the businesses with the most exciting model. They may be the companies that can afford to wait longest for returns. Smaller AI companies face a brutal choice. Startups and independent model developers face a different decision. They can attempt to build their own computing infrastructure, but that requires enormous capital and exposes them to equipment obsolescence. They can rent capacity from the hyperscalers, but that makes them dependent on companies that may also compete against them. They can seek strategic investment from chipmakers or cloud providers, but that can reduce their independence and direct more of their future economics towards the financier. Or they can build smaller, more efficient models. That final option may become increasingly important. Recent research into AI inference economics argues that conventional graphics processors can be inefficient for some large language model workloads because they bundle enormous computing power with insufficient memory. Purpose-built alternatives may dramatically lower deployment costs for particular applications. The industry may therefore split. A small number of companies will continue pursuing the largest frontier systems. A much broader group will focus on efficient, specialist, or open models that can operate with fewer processors and less capital. The sell-off is not necessarily predicting the death of AI. It may be predicting the end of the assumption that every company must build at frontier scale. The dot-com comparison is useful, but incomplete. The current market resembles the late 1990s in one important respect. A genuinely transformative technology is attracting more capital than every investment can profitably absorb. The internet did change the economy. Many internet companies still failed. Telecommunications providers built enormous networks that later proved valuable, but early investors often paid too much or financed them badly. Artificial intelligence could follow the same pattern. Data centers constructed today may become the foundation of a more productive economy. The models operating inside them may transform medicine, logistics, finance, and public services. That does not mean every data center project will earn an acceptable return. It does not mean every processor manufacturer can preserve today's margins. It does not mean every model developer can survive its financing burden. Technology can succeed while the investment bubble surrounding it partially collapses. That is the distinction markets are beginning to price. The sell-off, a test, not a funeral. Tailored previously examined how the AI stock crash exposed the market's most dangerous unanswered question, whether spending was growing faster than the revenue required to justify it. That question has now become more urgent. The market is also repeating the pattern seen when Wall Street's biggest technology winners suddenly became its biggest losers. Concentrated expectations can produce concentrated losses when the narrative weakens. At the same time, national and corporate investment has not stopped. Samsung's enormous expansion plans illustrate how the AI chip race is increasingly becoming a contest between states, supply chains, and industrial systems. The boom is continuing. It is simply entering a more dangerous stage. The first stage rewarded anyone who could promise exposure to artificial intelligence. The second stage rewarded the companies capable of supplying scarce processors. The next stage will reward those able to finance infrastructure, keep it fully utilized, and convert computing power into cash before the equipment loses value. That is a much smaller group. The AI sell-off is no longer mainly about whether the technology has been overhyped. It is about who can afford to finish building it.